The market is an arena where the mind is tested far beyond mere numbers. Few understand this more than the greatest investors of all time. Those who soar beyond balance sheets and charts into the hidden currents of human behavior that move entire economies. Imagine standing at the edge of a volatile stock, every tick of the price a heartbeat, every rumor a potential trap. In these moments, fortune favors the mind that can control fear, the nerve that can embrace uncertainty, and the vision to see opportunity where others see only chaos. Consider the paradox of risk. The market punishes the unprepared, but rewards those who study the psychology of crowds. Legendary investors like Warren Buffett and Charlie Munger often speak of patience, rationality, and discipline. But beneath these principles lies a deeper truth: the ability to detach oneself from the seductive pull of emotion. It is not enough to know the fundamentals of a company. One must know the fundamental weaknesses of the human psyche. Greed, overconfidence, and the fear of missing out, these are the invisible hands that drive short-term volatility. Jesse Livermore, often cited as one of history's most brilliant traders, mastered this principle centuries ago. He wrote of market behavior not as mere price action, but as a reflection of collective human sentiment. When others were euphoric, he sensed danger. When panic gripped the crowd, he smelled opportunity. His greatest insight was not technical, it was psychological. Markets are never wrong. Opinions often are. This distinction separates the casual trader from the investor who leaves a mark on history. To understand the mind of a master investor, we must dissect the emotional landscape of trading. Fear and greed are not abstract concepts. They are physiological states that can hijack decisions. Studies of market behavior show that human brains react to gains and losses asymmetrically. Losses feel twice as painful as gains feel pleasurable. This is the biological reason most traders sell in panic and buy in euphoria. The great investors invert this instinct. They are comfortable standing against the herd. They see a price crash not as a disaster, but as a doorway to value. Let's dive into the mechanics of this mastery. Great investors cultivate three internal systems simultaneously: analytical rigor, emotional resilience, and disciplined execution. Analytical rigor is the capacity to assess intrinsic value without bias. Emotional resilience is the ability to sit through volatility without panic. Disciplined execution is the ability to act when all conditions align, regardless of personal ego. Few can synchronize these elements, and fewer still can sustain them over decades. Yet those who do often generate returns that seem almost supernatural to casual observers. Behavioral psychology offers a lens to understand why the masses fail where masters succeed. Cognitive biases, anchoring, recency, herd mentality create predictable mistakes. The crowd often fixates on recent price movements, extrapolating trends indefinitely. The greatest investors recognize these patterns, exploiting the temporary irrationality of others. Buffett's principle of be fearful when others are greedy is not mere aphorism. It is an application of behavioral economics in real time. Every market bubble contains a mirror of human weakness, and every crash contains a mirror of human overreaction. History confirms this repeatedly. During the dot-com bubble, investors poured billions into companies with no earnings, seduced by hype and fear of missing out. Meanwhile, seasoned value investors quietly assessed the real profitability and sustainability of businesses, sometimes waiting years before making decisive moves. Their patience was not passive, it was a deliberate psychological strategy. They understood that time is often an investor's most powerful ally. Price may fluctuate wildly, but intrinsic value tends to assert itself eventually. Even today, in the age of algorithmic trading and social media-driven speculation, the same principles hold. The emotional triggers have evolved: retweets, memes, viral news, but human psychology remains constant. Those who control their reactions, who remain anchored to rational assessment rather than short-term noise, continue to outperform. Modern investors who study market sentiment, employ tactical patience, and maintain a long-term vision echo the lessons of Livermore, Buffett, and Munger. The medium has changed. The mastery has not. But mastery is not merely reactive, it is proactive. Great investors cultivate awareness of their own vulnerabilities, mapping out emotional triggers and stress points. They simulate worst-case scenarios in advance, reducing the likelihood that panic will dictate action. They understand that the market is an unforgiving teacher. Mistakes are inevitable, but learning from them without ego is the hallmark of enduring success. This is why the greatest investors often emerge from failure, not luck. Each loss becomes a data point. Each error a stepping stone toward refined judgment. In this first layer of understanding, we see that investing is a psychological discipline before it is a financial one. The charts and fundamentals provide context, but the real advantage lies in controlling the mind. Fear, greed, and impatience are not mere obstacles, they are signals, indicators of where opportunity and danger reside. The investor who masters these forces does not merely ride the market. They move with it, sensing its rhythms, anticipating its swings, and striking when conviction and conditions align. The greatest investors are not those who see the future perfectly, they are those who understand themselves perfectly. They accept uncertainty, embrace volatility, and harness the raw forces of human emotion to their advantage. In a world dominated by fleeting headlines and relentless speculation, this self-mastery is the ultimate edge. For those willing to study not just the markets, but the human heart within them, history offers a roadmap. The path is difficult, but the rewards are transformative, measured not only in wealth, but in wisdom. Markets are unforgiving theaters of both triumph and tragedy. To understand the greatness of investors, one must walk through the corridors of history, where fortunes were made and lost not by luck, but by insight, courage, and psychological mastery. Take the crash of 1929. The world teetered on the brink of collapse, panic gripping every street and trading floor. Amid the chaos, Jesse Livermore, already a legend by then, did not flinch. While millions sold in terror, he analyzed price, behavior, volume, and sentiment with meticulous discipline. He saw patterns in panic that others dismissed as randomness. By shorting aggressively, he transformed catastrophe into unprecedented profit. Livermore's success was not merely technical, it was psychological. He understood fear as both a signal and a weapon, and he wielded it with surgical precision. Similarly, the post-war era produced its own icons. Benjamin Graham, the father of value investing, introduced principles that forever altered the landscape. He studied companies as if dissecting living organisms, evaluating assets, liabilities, and intrinsic worth. Graham's genius lay in his combination of rigor and detachment. He preached the importance of a margin of safety, not only as a financial buffer, but as a psychological shield. Investors trained in Graham's methodology were armed against the emotional turbulence that often accompanies market fluctuations. The margin of safety allowed them to act with conviction, even when the crowd screamed in panic or euphoria. Consider the infamous trade of George Soros. During Black Wednesday in 1992, Soros recognized a structural flaw in the British pound, analyzing macroeconomic data, interest rates, and European exchange rate mechanism mechanics. While the majority of institutions struggled to reconcile short-term politics with market forces, Soros acted decisively, shorting the pound on an immense scale. His profit exceeded $1 billion in a single day. Beyond the numbers, this trade exemplifies a recurring principle among history's greatest investors: the fusion of knowledge, conviction, and timing. Soros did not guess. He calculated. He combined macroeconomic understanding with fearless execution, a rare convergence of intellect and psychology. History also teaches the cost of ignoring these lessons. The dot-com bubble of the late 1990s is illustrative. Companies with no earnings, no profits, and no sustainable business models saw their valuations skyrocket on hype alone. Retail investors, and even some institutional players, were swept up in the illusion of perpetual growth. Yet, amidst this frenzy, seasoned investors like Warren Buffett and Peter Lynch observed the irrationality quietly. They waited. They analyzed cash flows, earnings stability, and competitive moats. When the bubble burst, those anchored in valuation principles remained secure, while the emotional crowd faced ruin. The lesson is stark. Opportunity is born in the shadow of collective delusion. Another remarkable example lies in the commodities markets. During the 1970s oil crisis, traders confronted not only supply shocks, but global panic. Prices doubled and then quadrupled. Yet only a few investors anticipated the sustained trends. Paul Tudor Jones, a master of macro trading, capitalized on these movements by integrating technical analysis with sentiment reading. He gauged the psychological state of the market, identifying points where fear and greed peaked, and executed with disciplined precision. In each case, the ability to read collective emotion crowd psychology was as vital as understanding charts or fundamentals. Even today, the echoes of these historical triumphs and failures resonate. Consider the 2008 financial crisis. Lehman Brothers collapsed, credit markets froze, and panic spread globally. Investors who relied purely on models without psychological insight were decimated. Those who combined fundamental analysis with understanding human irrationality, like John Paulson, targeted opportunities hidden within panic. By shorting subprime mortgages, Paulson transformed the collective misjudgment of risk into staggering profit. History shows that major market events are often less about the mechanics of finance and more about the dynamics of human behavior, amplified under stress. The recurring thread through these historical episodes is unmistakable. The greatest investors act with conviction when others succumb to panic. They anticipate emotional overreactions, exploit cognitive biases, and cultivate patience. These traits are timeless. Whether in the roaring 1920s, the post-war boom, the dot-com frenzy, or the financial crisis of 2008, the formula remains consistent: meticulous analysis, psychological insight, and fearless execution. Historical mastery is not measured by the absence of risk, but by the ability to navigate it when most cannot. But history is more than a record of profits. It is a mirror of human behavior. Each crisis reveals patterns of overconfidence, herd mentality, and fear. Great investors are students of these patterns, learning not only from their own experience, but from the collective mistakes of generations. They codify these lessons into principles that guide future action, transforming ephemeral opportunity into enduring strategy. Understanding the past is not nostalgia, it is preparation. A roadmap for operating where chaos reigns. In examining the annals of financial history, a subtle yet powerful truth emerges. Mastery is as much about temperament as intellect. Numbers can be analyzed, charts can be plotted, and models can be constructed. Yet the discipline to act against prevailing emotion, the patience to wait for alignment between analysis and opportunity, and the courage to confront uncertainty, these are traits honed through experience and self-awareness. The greatest investors of all time have consistently demonstrated this alignment between mind and market. Through these historical vignettes, one principle is clear: fortune favors those who can perceive not only value, but also the psychology of those who fail to perceive it. Market crises are not merely economic events. They are stages upon which human behavior is magnified. The investor who navigates these stages successfully does so by understanding both the market and the human heart that drives it. It is a lesson repeated across decades, continents, and asset classes. History does not guarantee success, but it illuminates the path for those willing to study, observe, and act with insight and discipline. The market of today is a far cry from the trading floors of the past, yet the principles of mastery remain unchanged. Technology has accelerated speed, algorithms dictate intraday movements, and social media can ignite a global panic in seconds. Yet, amidst this complexity, the greatest investors still rely on timeless truths: discipline, psychological awareness, and strategic patience. The tools may have evolved, but human behavior, the heartbeat of all markets, remains constant. Consider modern equity and ETF markets. Volatility has increased, correlations between assets have tightened, and retail influence has surged. Platforms like Robinhood or trading apps amplify herd behavior, often causing irrational price spikes or crashes within hours. However, investors who apply the lessons of history and psychology can navigate these waters with precision. They treat market surges and collapses not as emotional signals, but as data points, opportunities to apply rigorous analysis. The modern investor's edge lies in integrating technology with timeless insight. Using analytics to confirm judgment rather than replace it. Cryptocurrencies exemplify this dynamic vividly. Prices swing wildly on sentiment, news, and narrative. Here, the psychological principles of greed and fear are magnified. Emotional discipline is not optionally, is mandatory. Savvy investors avoid the trap of short-term hype and focus on underlying adoption trends, network fundamentals, and macroeconomic positioning. They construct a mental framework to filter noise, identifying when the crowd is irrationally exuberant or unduly pessimistic. By combining historical insight with modern analytics, they create a measurable edge in a market defined by volatility. How, then, does one operationalize this mastery today? The process is deceptively simple in principle, but rigorous in execution. First, establish a foundation of analysis. Identify intrinsic value, assess risk, and determine market context. Second, cultivate psychological awareness. Recognize your own cognitive biases and emotional triggers. Use journaling, simulations, and reflection to reduce the likelihood of impulsive decisions. Third, develop rules for disciplined action. Define entry, exit, and stop-loss criteria in advance. Execution without ego is the differentiator between potential and performance. Fourth, monitor continuously, but do not react to noise. Historical precedent shows that patience often compounds opportunity far more than reactive trading. Step 5 is the integration of modern tools. Advanced charting software, sentiment analysis, and algorithmic backtesting are not crutches. They are instruments. They allow for faster recognition of anomalies, confirmation of patterns, and enhanced decision, but they cannot replace judgment. The edge of the greatest investors lies not in software, but in the mind, the ability to synthesize information, anticipate emotional overreaction, and act decisively when the conditions are right. Finally, step 6, reflection and adaptation. Markets evolve, but psychology does not. After each trade or investment cycle, assess what worked, what failed, and why. Embrace errors as lessons, not as blows to ego. This reflective practice transforms short-term experience into long-term mastery. It is what separates great investors from transient winners: the accumulation of insight over decades, refined continuously against the backdrop of ever-changing markets. Let us bring these principles together into a cinematic vision of mastery. Picture the modern investor navigating a turbulent session. Charts flicker across multiple screens. News headlines cascade. Social media sentiment spikes. Yet, in the eye of this storm, the investor is calm. Decisions are precise, rules are followed, emotion is contained. The chaos around them becomes a canvas for disciplined action. This is not fantasy, it is a repeatable, teachable practice honed over history and adapted for today. The greatest investors, past and present, share a common thread. They are students of behavior as much as finance. They recognize that markets are reflections of collective human psychology, amplified under stress. They operate with patience, discipline, and clarity, understanding that fortune is rarely a function of chance. Rather, it is the result of calculated, confident action informed by both intellect and emotional mastery. As we step back and observe these patterns across time, from Livermore's exploits in the Roaring Twenties to Soros' macro plays, from Buffett's patient value investing to modern ETF and crypto strategies, the lesson is unmistakable. Mastery is not an abstract ideal. It is a method, a system, and a mindset. Each trade, each investment, each moment of hesitation or courage becomes a building block in the architecture of enduring success. In the final analysis, the greatest investors of all time teach us that markets are not merely places of profit and loss. They are arenas of human behavior. They demand intellect, yes, but more importantly, they demand self. They reward those who act with insight, patience, and emotional control. And they punish the impulsive, the greedy, and the overconfident. By studying history, observing behavior, and applying disciplined methods in today's markets, any investor can align themselves with the timeless principles that have created fortunes and legacies. The market will always test you, always challenge you, and always reflect the human heart. But for those willing to learn, to observe, and to act with disciplined courage, it offers not just opportunity, but mastery, the rarest and most enduring reward of all. In the end, investing is less about predicting the future, and more about mastering the present. The greatest investors did not control the market, they controlled themselves, and in that control lies the ultimate power. The ability to thrive where others falter, to see what others overlook, and to turn the relentless currents of human behavior into lasting success.